Welcome to the OANDA Market Pulse charting analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Today we're going to take a look at a number of currency pairs, see how the previous week panned out and what it's left us with this week, and see what we can really gauge from the charts at the start of the week. Now, as always at the start of the week, we're going to pay a bit of attention firstly to the weekly charts, because it's very important to see exactly how the last weekly candle closed and what it is that we can gauge from this. We'll start with euro-dollar, with it being of course the most widely traded pair, and as you can see we kind of remain range bound here. We did nip back to 107 last week, but broadly speaking we are still being between this 108 and 110 trading range, but there's still plenty that we can gather from this. Firstly, a look at last week's candle. If we just zoom in a little bit closer here, for one, we've got this long lower wick. Now that suggests to me that despite the fact that it came back to these 107 levels, not only was it well defended, but we actually closed the week above the opening levels. That is quite a bullish signal. It's effectively a hammer. Now I know they were not really indicating the end of a downtrend given where we find ourselves with the euro dollar, but this is still a very this still suggests to me that the market is fairly bullish at these levels. So any idea that we could come back towards these 104.50s to 105s in the short to medium term doesn't seem very likely to me. I do think we are probably going to remain somewhat range bound potentially over in the coming 2 or 3 weeks, but this suggests to me that if there is a bias in the market, then it suggests to me that the bias is more bullish than it is bearish. And a look at the daily chart supports this potentially as well, because not only did we see a pullback at a close above the opening levels, but you can see that what we bounced off here is the 61.8 Fibonacci retracement level from the 3rd of December lows up until those 15th of December highs. So again, that's quite a bullish signal. Now we're far from being in a point of confirmation here. You can also see Friday's candle as well, which again is fairly bullish, because we had that pullback to 108 where we found support once again in that trading range which I highlighted previously. But then we got this massive lower wick again, because not only was it defended this support level, but we actually saw it move right back towards these opening levels again. These aren't strong bullish signals, but they are just an accumulation of small bullish signals, which suggest to me that if we are going to see a break out of this trading range, this 107 to 110 or 107 111 trading range, then it suggests to me that it may well come to the upside based on these little signals which we are getting, including the bounce from that 61.8 Fibonacci retracement level. But for now, it does look to me like we are going to remain within that maybe the tighter trading range 108 to 110, or even the broader trading range 107 to 111. It's only once we see a break above those two break above or below those levels, that I'll start to anticipate further trending markets, be it bullish or bearish. Cable next, and again we saw a nice candle here. We've highlighted already recently the acceleration, the bearishness. Now cable's been bearish for more than half a year now, but we did see this accelerate a few weeks ago. We saw it break below this descending channel which the pair had been trading in. We then saw support levels, support after support, come under pressure, the most important of which for me is this 145.60 level. Now this is the lows from April last year. It's also a multi-year low, and the fact that we've seen not only a move below this level, but we've also seen a weekly close below this level, with the weekly candle closing near the week's lows, which again is quite a bearish signal, suggests to me that the market has become far more suggests to me that the bias in the market is far more bearish. These 145s are currently providing support, but as you can see, again if we just zoom in here, you can see that this the way that we've started this week looks more like consolidation than it does any type of bounce. I guess this would be referred to as a dead cat bounce, because we are seeing a little bit of a bullish play at the start of the week, a slight pairing of the risk averse trading which we actually saw last week, and this is what you'll see throughout the markets. I think today, that's what we've seen so far throughout the markets, is you get the risk aversion play which we had from the start of the year. That's where you see things like the yen, the Swissy, the euro to an extent get some support, and then when you see those risk averse plays unwound and we see a bit more risk appear in the markets, then you see the other currencies start to come to their own, and it looks like what we're seeing is a pairing of that risk averse play from last week, which is why things like the pound are doing well, and as we'll see in charts coming up, other currencies such as the Australian dollar are also seeing some of the benefit today. But like I say, this looks to me more a case of a consolidation at this stage. Rather, I'm not seeing any reason to anticipate anything more than a consolidation, not even a retracement of any significance at this stage. I'm still looking back towards these 142.30 levels. These are multi-year lows that we've highlighted on previous videos, but the fact that we've had a weekly close below the 145.50s is very bearish for me, and I think once we've had consolidation or a minor retracement, I think we are going to be in the coming weeks looking back towards, coming weeks or months, looking back towards these 142.30s. Next chart I wanted to highlight is dollar yen, and again I think we've seen a significant move here. We've seen, if we look at this weekly candle for one, that's an extremely bearish candle. It's of course we've got this small upper wick, but really it is very small. We have this is effectively a Marubozu candle. We closed at the week's lows, or extremely close to the week's lows. Actually, we closed 1 pip above the week's lows. This is a long Marubozu candle where we closed at the week's lows. That's a very bearish signal, and again, what we've got here, not only did we close at the week's lows, but we closed below this 118. We had this 118 to 118.50 support that we'd highlighted previously, which has been a notable level of support in March to May last year, and then again in September and October. We saw a weekly close below there. We've seen a Marubozu candle. Now today we are seeing consolidation and a brief maybe even a brief retracement here, but I do believe this is a bearish continuation pattern. Of course, this is a weekly candle. There's still 4.5 days to go, but even if we look at the daily chart here, this looks this candle that we've currently got. Again, we need to wait for the closing candle, of course, but this does currently represent indecision in the markets, and that could be the form of consolidation, or it can suggest we're going to see potentially reversal. It all depends on how the next candle shapes up, but all we have to do is look at the candle movement prior to this. We saw a retracement on Friday, and these resistance levels around 118.80 were staunchly defended, and we saw it sell off after reaching those after the initial rally early in the session. We saw it close below the opening level, so we've got this long upper wick. This for me is quite bearish, and in fact, again, this just adds to the bearish outlook that we have for this pair, and we may see a brief retracement, but for me, I'm still remaining bearish, and I think these 115.50 to 116 levels is where we're looking at next. This is the next key level of support for this dollar yen pair, and all you have to do is look at this to see how important it is. It was a notable level of support back in December of 2014, in January of 2015, in August of 2015. It's a clear support here. We've also got the 89 week simple moving average potentially providing additional support here. Of course, all you have to do is look back to see how important this has been in the past. They're not always important, I should stress, but you can see here in the past, during this period of sideways trading, it wasn't overly reliable indicator, but prior to this, you can see that at this point here, we did offer some resistance. If we keep going back again, of course, this is a weekly chart, so we've got to go back some way. But during this period of consolidation again, we could see that the pair the 89 week simple moving average did provide support here. It provided support here as well. These things aren't always perfect, but I think you can see from this, it's I wouldn't say it's an overly reliable indicator of support and resistance. Moving averages never are entirely reliable. I like to combine them with other support and resistant indicators, and here we've got a prior level of support and resistance, 115.50 to 116, and this just happens to coincide at these levels as well. It just adds that little bit of confidence in a support or resistance level. If we see this broken as well, you can see that really we are looking at a significant move back, maybe towards these 110 levels, which was resistance back in October of 2014. So quite a significant drop potentially if we see these 115.50 to 116 levels broken, which is why, once again, this is a very significant level of resistance for the dollar yen pair. WTI, quick update on, again, we saw a very negative week for WTI. Overall, WTI and Brent crude both declined by more than 11%. So a very poor week for oil once again. You can see that the next real notable level again is around those $30 a barrel levels, which we've highlighted previously. 32.15, 32.20 coming under significant pressure. Now, we did see it trade below here last week, although it did close around those support levels. If we look at the daily, really this potentially supports the more bearish outlook, simply because as of yet, while we failed to close below that support level, we are seeing more downside pressure. The real key here, or the real strong indicator from this, is going to come from today's trading action in my view. We've got these lows here from last Thursday, which is 31.58. If we trade below those lows, that would suggest to me that there's enough bearish traders in the market to pull this back towards these $30 a barrel level. If we by the close of today's session, if we fail to break below these 31.58 lows from Thursday, that may suggest to me that the bulls are coming in and defending this level, or it could suggest that we're seeing some profit taking. Either way, that would suggest that we're maybe going to have to wait a little bit longer for these $30, this $30 level to be reached, and we may, in the meantime, see some form of retracement or correction. But again, one thing you can see here is on Friday we did see a bit of a retracement back to these prior support levels around $34 a barrel. These are support from December 13th and from December 14th and December 21st. We saw this move back towards these levels. This was sold into quite aggressively, and we actually saw it close lower on the day. So again, there's little bearish indicators going on here, and this, for me, I think is still looking bearish, and I do think we are going to see $30 hit or even broken in the short to medium term. Next is gold, and again, another significant break here. We're seeing a lot of strong moves in the markets right now. It's a fantastic time to be following the markets because there's so much interest going on. There's so much key technical. As a technical analyst, there's a lot of technical levels being broken, which make it far more interesting from the times when we can sometimes see very little interesting price action in some of your major currency pairs and commodities. But right now we've seen 1090, 1100 actually broken, but we've also seen a close above. Again, look at that, it's a very bullish looking candle. What's more is, aside from closing above $1,100, which in my view is quite bullish, it's a prior level of support. We are seeing some pairing of these gains today, but you can see it's only gradual. This again looks more like consolidation to me. It's a candle that represents indecision at this stage, but the fact that we've got a small upper and lower wick suggests to me that this is more consolidation, bullish, which is a bullish continuation pattern in this sense, rather than an indication of a reversal here. We go back to the 4-hour chart, and again, this potentially looking like a triangle or a pennant or something along those lines. But again, these are all bullish continuation patterns. These tend to be bullish continuation patterns, but it's still early doors yet. We'll probably learn more about this in the coming 24 hours or so. But right now, this is looking fairly bullish to me. If we do see a pullback, then I will be looking at these 1090 levels once again to potentially provide support, given that they had previously been resistance. The penultimate chart we're going to look at is Euro Sterling, and again, surprise, surprise, we've seen a key technical level broken. These 74 to 74.50 levels, which we've highlighted previously. Reason being, the reason it's so significant is because we had this descending trend line going back to August 2013, so a long-term descending trend line, and we have seen this broken. Moreover, we've seen a close above the trend line, a very strong-looking candle. We saw some weakness earlier in the week, but then we've seen it rally, close at or very close to its highest levels. Again, this is a very bullish signal, and even though we are seeing a retracement today, for me this just is maybe a bit of profit taking, or we are just seeing a small pairing, a small retracement. We've come back towards these 74.50 levels, which is currently providing support. Given the fact it's prior resistance, that isn't a huge shock. For me, now that we've seen this close above here, I do think this is going to be an important level of support for the pair, and I think we could be looking back towards these 77 to 77.50 levels. Again, prior levels of support back in October 2014 and again back in July 2012. But for me, this is still looking quite bullish, regardless of the selling that we've seen in the pair today. Of course, if we see a close below Friday's open, that may raise a few questions about what kind of pullback we could get. Again, like I say, this looks like a consolidation at this stage, potentially a bullish continuation pattern. If we see a close below Friday's open, maybe that would be the first suggestion that we are going to see a bigger retracement, maybe a 50% retracement back to some more attractive levels. Supporting that potentially is the fact that we've got this bearish divergence You can see that of the last two highs that this pair has made, it's made it on falling momentum. If we're looking at the MACD histogram here, this is a bearish divergence and would suggest that maybe we are going to see a larger retracement. So this could be an interesting one to keep an eye on in the next 24 hours or so. If we see a bearish divergence and we see that combined with, I mean, of course, it's not, when I say this is a bearish engulfing pattern, it's not perfect by any stretch of the imagination. We've got this long lower wick, we've got an upper and lower wick on today's candle, so it's not probably a textbook bearish engulfing pattern, but the message is still the same. We are still closing below Friday's opening levels, so for me the message is still fairly similar. Given the fact that it's not a textbook bearish engulfing pattern, and given what a bearish engulfing pattern typically indicates, given the fact that not only you're closing below the prior sessions open, you're also effectively setting new lows for across those two sessions as well. So if we are going to see, for me to get in any way bearish in the short term on this, I would like to see, as well as a close below Friday's open, I'd also like to see Friday's lows 74.21 actually broken to the downside, and that might make me a little bit more bearish. But in the meantime, I remain bullish on this pair at this stage. I still think this is consolidation. I still think there's more upside to come, and I think we'll see 77 to 77.50 potentially tested in the coming days or weeks. The final chart I'm going to bring onto the screen here is the Australian dollar against the US dollar, and again this just goes to show that we are seeing the risk trade favoured today, a pairing of the risk averse trade. Of course, your high yielding currency such as the Australian dollar would be included within that risk trade that I'm highlighting here. And this is what I wanted to highlight last week, but I think I actually missed it off. We've had a very poor start to the year for the Australian dollar, of course, given two things: given that it's seen as a risk-on trade, a risk-on currency. Also, its links to China, and given where all the turmoil stemmed from last week, it's no surprise that the Australian dollar was dragged down with it. We are now trading back. We've broken below $70, 70 cents to the dollar, which I think is very technically important. Moreover, I think it's very psychologically important. And we did see the week close at the week's low. Again, look at this for a bearish candle. This is as close to a Marubozu candle as you'll probably hope to see as a technical analyst. You've got the tiniest of upper wicks here. I mean, you're literally talking, it opened at 72.93 and its highs were 73.01, so 8 pips. The upper wick is only 8 pips in length. The lows, it actually closed 1 pip above its lows. I mean, this is almost as technically brilliant, technically perfect a Marubozu candle as you could possibly hope for. This is so bearish, and the fact that it's doing it around its multi-year lows, I think, is very important. Yes, we may see some consolidation this week. Yes, we may even see a bit of a retracement. We could even see it move back towards the 50%, the 50 back of last week's candle. If we look at last week's candle, the 50 back, of course, would be the Marubozu line, which can quite often be a good technical level. In this case, it'd be a potential technical resistance level. We may even not see that, given the fact that the upside momentum really is clearly lacking today, even though we are seeing a pairing of those losses. There doesn't seem to be much appetite for an upside move in the Australian dollar. I think we are potentially going to see these 69s come under significant pressure now in the coming days, or over the next couple of weeks, at which point, if we're looking at a break of this, we are looking potentially significantly lower. I'm going to have to go back, I think, a few years to find the Aussie dollar trading below this level. We are looking now, we're currently trading at these lows, which is of course coincides with the lows back in 2009. Really, we're looking back for a next temporary, this is, I wouldn't call this a major necessarily level of support, but the next notable level of support then would be 67.50. Really, the next major levels that we're looking at here, going off their past performance, we're looking all the way back at 63s. Really, of course, this could be weeks or months away, but that's how significant this current support is for me, and I think we could potentially be looking significantly lower in the coming weeks and months if we can see that last year's lows actually broken in the Australian dollar. So I think this is going to be, again, another very interesting currency pair to be watching in the coming days. And again, today's price action doesn't really fill me with bullish confidence. It looks more like bearish consolidation. Bearish continuation pattern, consolidation. Already we are seeing, you can see in the last 4 hours actually, we have seen a move to the upside, and already we've seen the last candle's lows broken, which is very bearish, and also you've got this big red candle now this really does look like textbook. A textbook retracement or consolidation, whichever you want to call it. Maybe a 76.4% retracement, something along those lines. But for me, this remains very bearish. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you in your trading.